Welcome to the Market Pulse podcast from Equifax, where we break down the latest economic and credit insights to help you navigate today's business landscape.
Welcome to today's Market Pulse podcast. I'm your host, David Adams. I'm the head of commercial product marketing here at Equifax. And today's topic is small business fraud. I'm also very excited to welcome Jill Molitor, our guest speaker here today. She is the Director of Fraud and Credit Administration at Stearns Bank and an expert in this particular subject. So Jill, thank you again for joining us today. We really appreciate the time.
Thank you. Likewise.
Now, before we kind of jump into today's main conversation, we're going to do a quick macroeconomic update from Shandor Witcher, an economist from Moody's Analytics, and we'll be right back with you. Go ahead, Shandor.
The U.S. economy continues to show resilience, with our high-frequency GDP model expecting the economy to expand nearly 3% in the second quarter. Job growth slowed in June, with the economy adding 57,000 jobs in the month, down from 129K in May. Now, also notable from the report were downward revisions to prior months. This brought the three-month moving average to 111,000 monthly gains, down from 164,000 in the month prior. The unemployment rate fell from 4.3% to 4.2% in the month, though this was driven primarily by workers dropping out of the labor market. Now, the inflation picture did improve in June. Consumer prices fell 0.4% month over month, and this was driven by steep declines in energy prices, which fell 5.7%. The most encouraging figure from this month's report, however, was that core CPI, which excludes food and energy and tends to provide a better view into underlying inflation, was flat in June, which should quiet concerns of a near-term rate hike. Now, that said, with tensions re-accelerating in the Strait of Hormuz, the inflation picture is still in flux, so we'll have to keep an eye on it.
Excellent. Thank you for the update, Shandor. I really appreciate it. Now let's get into the meat of the conversation today. And small business fraud. Jill, I guess it's been a 3 weeks now. You were kind enough to join us for our Market Pulse webinar. Got a lot of feedback from folks. You guys covered a lot of topics, but there is no question by far fraud stood out more than anything else. And, it's interesting. You and I have known each other for a few years now, and we've talked a lot about speed to market. We've talked a lot about process. And what was it? Even before today's call, we were talking about it. It's like, before it used to be automation and strategy. What is it? That was so 2025, right?
Yes.
The interesting thing about it is I can't pinpoint that moment that it shifted from like the process and some of those things and automation to now fraud being such a hot topic, because it was all about let's go. And I know your experience is we're hearing a lot more of, hold on a second, fraudsters are getting really good. Like, how do we make sure that we stay quick while not letting in some of the fraudsters and things like that? Like, are you guys seeing that push and pull over there at Stearns Bank? Like, what are the things that you guys are looking at? Where are you guys going with that? What are you seeing?
Yeah, so thank you for that question, David. And that is such a loaded question, because we really need to approach each phase of that onboarding process with caution. And it does open the door to fraud. You talk about synthetic identity, which I call the Frankenstein fraud. We talk about identity theft. We talk about equipment that is ghost equipment. It doesn't even exist. And so let's really just take a step back, and we'll start with that onboarding process, because identities can pass those historical check the box types of safeguards that worked for years, and we need to be really careful for that. So in other words, when we're talking about synthetic identity, that is one of the really hot topics. When we're talking about AI, we're talking about deepfakes. It has become easier and easier for bad actors to create these Frankenstein identities. And the people have a name, they have a social security number, a date of birth, physical address, phone number. Photo identification can be easily purchased on the dark web or even created by the bad actors. They get very creative by applying for credit, by knowing that they're going to be denied, but they're creating a footprint. And so then eventually they receive a yes from a creditor with this identity that they built, and they're starting to build that credit profile. they'll maybe get a credit card, and then pretty soon it's an auto, and eventually they're moving on to some larger purchases, and eventually they bust out where they stop paying and you're left as a creditor high and dry, no recourse because this person and business didn't exist. So they're creating synthetic identities, and it works for them. They're going to continue to find ways to obtain credit and the money or goods that go with it because they've already started to create a new identity once they bust out of that first one and leave you high and dry. Business perspective, they're looking at Secretary of State filings that maybe have been active at one point, and they're reactivating them. They're creating newer identities through those Secretary of State filings because they're creating a time in business by looking at something that maybe needed to be revived. They're slipping in some of these synthetically created personal identities and making it look like we have a business and a person that is operating these. They could very easily fabricate a web page where they're taking pictures from other web pages that they have used or that they have found that have equipment that they're supposedly selling. So they're looking like they're a legitimate company, or they might even take the web page of an existing company and change those details ever so slightly so it looks like that it is the bad actor that's using that business. But then they'll maybe slap in a false phone number and web page to redirect people to that falsified web page. So if we look at those couple of pieces, like from a traditional know your customer, they have a name, check, address, check, date of birth, check. Let's check the boxes. So it's like, let's go, let's give them some credit. So the curveball then, we have legitimate person, legitimate business applying for credit. A bad actor might use tools to intervene a legitimate transaction where maybe they're sitting in somebody's email for a while and they're waiting for that moment when wire instructions get passed through, and the bad actor will then slip in falsified wire instructions that are being redirected to an account controlled by them. And all of a sudden we've got a legitimate dealer, legitimate customer, and they're like, well, I'm not giving you the equipment because you didn't pay me. And the bank's like, we sent you the funds. So that's another way that these bad actors and in today's day and age are committing some sort of identity theft. So we really need to make sure that we're vigilant in understanding and using our tools to look through and not check the box, but really verify that we know who we're doing business with. If something changes along the way, we need to take the time and have a human look at that and intervene and ask ourselves, does it make sense? So we can, to an extent, use those traditional verification methods, but we also need to make sure that we're using those with logic.
Yeah, no, it's a great point because it's you can still stay quick, you can still stay efficient if you're keeping an eye on things. But to your point, a little bit of due diligence really does help kind of solve some of the problems. The ironic part about it, I remember, even just a couple, 3 years ago, that when you heard synthetic ID, you're like, oh, that's a consumer, that's an individual, or, account takeover. Now it's like fraudsters have just taken what they learned there, brought it over into the business world. The thing that, and we've heard this a couple of times too, absolutely echoes exactly what you said, is with consumers and individuals, we have long history sometimes, and sometimes it's a little bit harder to create those synthetic IDs and whatnot. Companies are so much easier because of the number of startups, the number of applications and how they're coming through. So just as you said, it's like a business. Okay, it's a legitimate business. It's got a legitimate start date. It's got a legitimate address. It's got some of those things, but wait, hold on a second. David Adams isn't actually David Adams, or there's something else going on. And looking at both of those pieces together, just some of the basic checks, can really make a difference. But, I'll shift on you a little bit, because one of the things that we also hear is, and we have been getting this question so many times, which is, how are you guys using AI? How is AI going to solve this problem? And there seems to be this thought that this AI utopia is going to exist of, just plug in AI, it'll find the fraudsters and everything is great. There's one little twist, and that is many of the fraudsters are using AI to commit the fraud and go through that. Like there's little, it's those little tiny things that figure it out. And I think everybody is trying to figure out how to combat that a little bit more. I know you've seen some of that. Have you seen huge uptick, or have you seen the AI component kind of start to feed into that? Or is that still kind of out there in the ether somewhere and hasn't really reared its ugly head yet?
Yeah, it is. It's out there. And as financial institutions, we have the responsibility to ensure that our customer data remains safe. And so you'll hear ourselves and a lot of financial institutions that say we are implementing AI very strategically and very carefully, where we need to completely vet that process. Now, while we're doing that, we also need to make sure that we're aware of and that we're vigilant of fraudsters who are using AI. And it's there's tools, there's machine tools that we can use, because AI is, what is it? It's a machine that's learned. It's learned behavior. So we can use our existing tools without even implementing an actual AI to look for velocity checks. So measuring how quickly certain events occur. Like if somebody has multiple failed attempts on the same card, if the same device, same IP address, rapid account logins, out of pattern deposits, things like that. So if there's geographical differences in like where a customer is located and the dealer is located, that can flag us where we need to look deeper into it. So even without directly using AI, we can use tools. We can develop tools that will research and understand patterns. And we can use those patterns that are pulled forward as pink flags to further look into those. So we can train something to pull forward those flags. And that machine is doing what it's trained to do. But then we need to be very careful that these aren't false positives, because it might make sense. In today's day and age, you talk about AI, David, and what are people doing on the internet? They're looking for the best deal possible. AI doesn't look for that best deal possible necessarily, but you are going to use your computer. You're going to use open source searches to look for the best pricing or the best equipment or the best vehicle. If you want something that's extremely customized, you might buy that from a dealer that is geographically far away from you. And so we can use our detection to say, hey, does this make sense? But it doesn't mean it's necessarily fraud. That just means we pull it forward, and our human brains need to look at that and ask ourselves questions. Does this seem logical? Does it make sense? It might. And if it doesn't, and when it doesn't, then we need to dig deeper and look for those other patterns of potential theft, true identity theft, synthetic identity theft. So the other thing I would say too is that just asking those logical questions, even when we are manually underwriting credit applications or manually reviewing identities and comparing the consumer credit to the business credit. Does it make sense for a business to be located in California, but the owner or owners are operating maybe in Florida? Maybe there's one in Florida and one in New York. Does that make sense? So it's asking questions like that. Or if you have an identity that is pulled forward because there's a possibility that it was synthetically created or something doesn't seem correct, looking at the date of birth. Was that date of birth, does it make sense in proximity to how long the company has been around? Maybe there was an ownership change, so then it makes sense. We have to ask questions. Was the Social Security number issued in the last 5 years? But this is somebody who we would have expected to have had credit for many years prior to that. That could indicate that there's digging we need to do. Those are just some of the things that we need to be looking for and monitoring, and a machine can't pick up those types of questions. So we need to make sure that we're looking into those. Another situation might be knowledge-based questions, going back to that Frankenstein identity. If they created that identity, they can answer their knowledge-based questions because they created themselves. So we need to be careful in those types of situations where if a lender or a salesperson or a credit person comes to us and says, well, they passed their knowledge-based questions. Yes, but there's these other pink flags that we need to dig into. So you can kind of talk yourselves in circles. And that's where we really need to, you can't look at any one of these pink flags in a silo. We need to pull them together, and we need to do it quickly and efficiently because that customer is waiting for a decision. And if we're not speedy but accurate, that's going to cost us one way or another.
Yeah, it's a really good point. And it kind of even ties into what we were talking about before is the customers are waiting. We've got to be speedy, but we got to be cautious. The velocity thing I think is really interesting as well. It's almost, as you were saying that, the first thing that came to mind was like trust but verify. Whether it's verify, is it a false positive? Is it real? AI can help out a little bit, detect some of those patterns, but there's still no substitute for that person, for the individual.
Mm-hmm.
AI is only going to be able to do so much. Like I even heard the other day that fraudsters, or that somebody came across an instance where a fraudster was using AI to generate, just like sort of like what you said around the knowledge-based questions. They can answer that stuff, but they were using AI to generate paperwork that would be used in like an underwriting process and background and information. The thing that was really interesting about it was the thing that popped was what you said around date of birth and the alignment, things like that. Like it was something crazy. Like the person had to be like 9 years old, when they started the company. But it's crazy. That wouldn't be picked up sometimes by the AI piece. It might only get picked up by that human thing. Like to me,
yes,
I think this applies all the way around in many ways with AI. Like combining AI and technology and people really makes that big difference. Gives a little bit of that, the knowledge that we have and the experience like you have in terms of doing this stuff for so long. So
yeah, you absolutely can't replace that institutional knowledge. You have to be able to use logic to anything that a machine has pulled forward, whether it's machine learning, whether it is information from a report, or whether it is from AI.
Something you said there, I want to go back to something because we've been talking a lot about fraud in terms of, call it third party fraud. People, true fraudsters, somebody that's coming in, that's making stuff up. I've made, synthetic ID. I've made a fake profile, fake company, all this other stuff. When we talked about consumer fraud, there's the first person, and you mentioned it before. Sometimes the bust out fraud, it's not just a fake identity and things like that. It's people that are actually coming in, maybe doing some loan stacking, trying to take advantage of a situation because maybe they're a little bit stressed in terms of their cash flow, and they're like, look, I'm not trying to commit fraud, but I'm definitely pushing the limits, or I'm definitely trying to get more money because I'm stacking up multiple loans. One of the things that we get questions about regularly as well is the difference between, again, we're credit reporting agency, the difference between score and capacity. Capacity has become a really hot topic. It's one thing to have a business score, or even using the consumer score of, make it up 600, but there's a big difference between that, somebody that's a 600 that's doing $200,000 a month in cash flows and $20,000 a month in cash flows, and where there's more debt kind of coming in and going out. I guess what I'm trying to figure out, and the question that we get often is there a way to be able to assess an individual's capacity to be able to return? Like, are there things that you're looking for from a stress standpoint? Like we see it in defaults and delinquencies. If somebody's in default or a delinquency, they're stressed out. But how do you see that otherwise? Like, are there other things that you're looking at, or is that just part of the overall picture for you guys?
Yeah. So again, you can't look at it in a silo, where you
Okay.
touched on it a little bit, David, where you said there might be somebody that has a 600 credit score, and they might pay as agreed, and they have there's a very solid reason, although a 600, that's a pretty low score. But it could, I've also seen people who maybe have a 750 score and that $200,000 in debt, and they're struggling, or they're on the brink of struggling. So you really, again, you can't look at that in a silo. You need to take a very holistic view. And by holistic, I'm talking about their financial capacities and looking at both the consumer credit and the business credit and understanding, do they have the capacity to pay their personal and their business bills? And so we're looking at their personal credit reports, and sometimes those have business debt that is reported on them, and taking into consideration, does that seem to marry up to the size of business that they state that they have, or to the equipment that they state they're going to be financing? So you really need to look at that holistic report. And then also, do they have affiliate businesses? And so what we're really talking about is global cash flow. And even without financial statements, especially in a flow type of a business, small ticket types of transactions, there's ways to at least deduce whether the request makes sense when you blend together what do the personal guarantors, the owners of the business, what does their personal credit look like, what does their business credit look like, and what does their business credit look like for their affiliates. And that's also going to help you determine, do they have debt stacking? Do they have a lot of UCC filings that have been made? What does the economy look like in their particular industry, in their geographical region? Does that make sense? So, and that can help us determine both on the front end, does this seem like a credit risk that's within our risk appetite? And from a collections perspective, do they show signs of debt stacking? There's tools that you can use that can help you determine, is there debt stacking, or are there shifts in their business score that we would want to pull forward to determine if we need to reach out to that borrower and talk to them about seasonality, or if there's a payment relief modification that we would need to consider to help them.
Jeez. I got to tell you, this would be a whole lot better if this was an easier process. I'm just telling you, what's funny is, again, we go back a few years and we think about fraud before, it was a little bit easier because fraudsters weren't nearly as sophisticated as they are today. And they're just getting better. Like your comment on the affiliates too, especially in a world where serial entrepreneurship is a common thing. And you might have people out there that have 2 or 3 or 4 or 5 different businesses that they're connected to. So that stress component is not, you can have one company that's stressed and another company that isn't. It would be nice to be able to go and tell everybody, oh yeah, it's super simple, this is really easy. But to your point, like, you really do have to look at it all.
Yeah. And it's not that they're trying to hide anything. Sometimes I might review a credit application where the applying entity has limited credit. But once we start to really understand the holistic approach and talk to them about their business, we find out that, well, this piece of our business is a startup, but we have this established business that is willing to step up to the plate and do a cross-corporate guarantee. And then we can strengthen a deal. So it's not necessarily bad. It's these are things that we can look for because we want to try and help and find solutions for our borrowers. It's not necessarily fraud, where it can go to a situation where it's like, oh my goodness, we didn't realize that one company was draining from the other, but it can actually strengthen transactions as well. And we can find solutions for what we at the onset or on the forefront, or what's initially presented to us would be presented as a thinner file. We can find out by talking to them and having conversations, or just doing due diligence internally, that they're actually a very strong guarantor and with strong affiliate companies.
Yeah. And so you've said a few times, looking at the big picture, looking at the whole picture, looking at those things. As you were saying that, one of the things, and you mentioned the owner a little bit, and it clicked a little bit in that, because I guess here's the thing, when you're looking at these accounts, you're looking at these affiliates, you're looking at these different companies, I've heard you say as well, understanding the whole owner, understanding the picture of the owner itself, so not just the business. Like, to your point, when you're kind of evaluating these things, are you looking at both the owner's consumer background as well as the business background? Are you using those two together to kind of understand a little bit and make more decisions? I know it's a little bit nuanced. Like we heard, as an example, one of the things that we continue to hear is people have said that a consumer's credit history, or they tend to bring those same behaviors into businesses that they run. So generally good consumer behavior echoes good business behavior. Bad consumer behavior, sometimes not always good business behavior. But I think that's very anecdotal. Like I don't think we've been able to validate, is it true? Is it not true? Like, are you looking at those kinds of things as a part of the evaluation process too?
Yes, absolutely. And to your point, most times one will mirror the other.
Okay.
And it's not always. It's not always that is the case, but in most cases you do see mirroring of others. Now, when you get to a very large company, well, then it might not make as much sense to look at that whole owner perspective, where meaning you're looking at their global cash flow. It is still a very good idea. And we would want to encourage that when we're doing our underwriting. But sometimes if you get to like a publicly traded company, that's just not something that is realistic. Or when you look at a company that is where it is a parent, and that parent has multiple umbrellas, then it might not make as large of an impact on a very small loan in comparison to their size, but it is something that for most small businesses we would be looking at.
Yeah, I can see that. I was going to say I hope nobody's looking at my personal credit when they're evaluating Equifax as a business. That is the same, boy. That might be a little bit awkward, but
yeah. Well, yes, and you're not. I don't think you're an owner of Equifax. So if you're not the owner, no, even the owner, it might be a little bit different because of the size.
I got some shares. It's fine. No, you're absolutely right. Well, it's this to me is a really interesting subject, because when we talk about fraud, fraud is sometimes very, it's negative. It's people are looking at it, bad people doing bad things. But this is a really, I'm always interested in this component as it relates to the owner. Because if you said it even earlier, if you're looking at the owner, their background, like a change of ownership in the business itself, like being able to do those little things, I think can help determine the difference between fraud and legitimacy. And if you can help delineate between those two, then you kind of go down to that next layer of, okay, we think this is good. We think the people are good. What can they really do? What's the capacity? How do we look at these things, together? We do see a lot of those trends with our consumer data and our commercial data together. So it seems to be lining up, and it's interesting to look. So I know we're coming a little bit towards the end, and so I think we might be able to close some things out, because and I think we kind of alluded to it a little bit, is, maybe we can look forward a little bit, break out our crystal ball, because AI, future of fraud, all those things that go along with it. Like, is there, if somebody were to come to you and ask you and say, hey, Jill, I need to do something today that's going to help me in 6 months, 12 months, 24 months from now, what would you recommend to them? Is there a true future-proof option? Is there something that somebody can be doing that solves that problem, or is it just an ever-evolving world that we're living in? Right?
Oh, it's always going to be ever-evolving, okay. And my crystal ball broke years and years ago.
Fair enough.
I keep trying to fix it, but some of the things that I would say is we need to use to conversations that we've had both today and in prior conversations. We need to continue to use our resources and rely on each other, and use both machine learning as well as human intervention, and apply logic to them. You can't look at either one in a silo, and we need to continue to develop and to train internally and externally. We rely a lot on training, because I only know that something seems fraudulent, or that from a credit perspective that something seems risky, if somebody brings it forward, if it's not a transaction that I'm working on myself. So we need to make sure, it's great if I have the knowledge, but we need to educate internally our team members and externally within our communities, so that they understand what trends to look for, what to monitor, how to bring those forward, and to feel comfortable bringing those forward.
We'll kind of close things out. I just want to, again, thank you so much for joining us. I really appreciate it. If anybody has questions, if anybody wants to reach out to you, what's the best way for them to be able to get a hold of you?
Yeah, absolutely. You can reach out to me on LinkedIn. It's Jill Molitor, and you'll find me under the Stearns Bank header. So absolutely
Perfect.
would love to connect.
Very good people. Again, it's been a pleasure knowing you these past several years, and I look forward to doing a lot more with you in the future. So thank you.
Thank you.
And to our audience out there, if you guys enjoyed the topic, if you have more questions, anything like that, please listen to our other podcasts, visit our market insights. If you have questions, reach out to our advisors at Equifax.com. We would also love to talk to you. We'd love to have a deeper conversation with you around fraud and verification and all the things and any other challenges that you might be facing in your commercial portfolios. In the meantime, thank you again for joining us.
The information and opinions provided in this podcast are intended as general guidance only and are subject to change without notice. The views presented during the podcast are those of the presenter as of the date this podcast was recorded and do not necessarily reflect official positions of Equifax. Investor analysts should direct inquiries using the Contact Us box on the Investor Relations section at Equifax.com.